You finally start investing, not because you want to get rich overnight, but because one day you look at your savings account and realize doing nothing is also a decision. So you buy your first index fund, maybe your first stock, maybe a little Bitcoin. And for 1 week, you feel responsible. Then the market drops 10%, 20%, maybe 30%. Suddenly, the question is not whether the market is crashing, the question is whether your confidence is crashing with it. At first, you try to stay calm. Every smart investor says not to panic. But then you open the app again, and the number is lower than yesterday. The loss is still small enough to survive, but big enough to feel personal. Before you invested, your money just sat there quietly. It did not grow much, but it also did not embarrass you every morning with a red number. Now your money has a mood, and today, that mood is bad. The awkward part is that your first crash arrives before you have built any trust in the process. You have not seen a recovery yet. You have not lived through a cycle. You only know one thing. You started investing, and then your money went down. That timing can do more damage than the loss itself. For a long-time investor, a crash is painful but familiar. For a beginner, it can feel like a warning sign that they made a terrible mistake. This is where the first wrong lesson appears. Maybe investing is only for people who got in earlier. Maybe ordinary people are always the last ones to buy before everything falls. That fear feels logical, especially when your first chart is red. But the bigger problem is not that the market fell. The bigger problem is confusing a bad entry week with a bad lifetime decision. You take one painful moment and turn it into a permanent identity. I am bad at investing. Then comes the second mistake. You sell to stop the feeling. Not because you have a better plan, just because closing the app is not enough anymore. You want the red number to disappear, so you turn a temporary loss into a completed one. For about a day, selling feels like relief. But then the market bounces a little. Not enough to prove anything, just enough to make you feel stupid in the opposite direction. Now, lower prices feel dangerous and higher prices feel unfair. This is how people accidentally leave investing forever. Not because they lost everything, but because their first experience taught them that investing equals stress, regret, and headlines they cannot control. That is the real danger of starting right before a crash. The crash can shrink your portfolio, but a bad reaction can shrink your future. It can make you avoid the habit that might have helped you build wealth over decades. The strange thing is that the exact same crash can create two different investors. One person sells, disappears, and says the market is rigged. Another person feels the same fear, but slows down, studies the math, and builds a system. The difference is not bravery, it is structure. A beginner without structure asks, should I sell today? A beginner with structure asks, how much was I supposed to invest? Over what time period? And what would actually make me change the plan? Your first investing plan cannot be based on confidence. Confidence disappears the moment the chart turns red. Your plan has to be based on rules you can still follow when you are nervous. Rule 1 is position size. If your first investment is too large, every red day becomes an emotional event. Starting smaller gives your brain time to learn market movement without treating every drop like a personal failure. Rule 2 is pacing. You do not have to invest all your money on one perfect day. Spreading purchases over time does not guarantee a better price, but it lowers the pressure of needing your first click to be perfect. Rule 3 is cash. If you invest money you may need next month, every market drop becomes a crisis. If your bills are covered and your emergency fund is separate, the same drop becomes uncomfortable instead of dangerous. Here is the twist. Starting right before a crash feels like terrible timing, but it can become one of the most valuable lessons you ever get. A crash shows whether you were investing or chasing, and whether your time horizon was real. So if you start investing and the market crashes, the useful question is not, was I unlucky? The useful question is, what did this reveal about my plan? Did I invest too much, too fast? Did I buy something I did not understand? Did I confuse excitement with strategy? The worst outcome is not losing 20% on a small first investment. The worst outcome is learning the wrong lesson. The wrong lesson is never invest again. The better lesson is never invest without a system again. The first crash does not just test your portfolio. It tests whether you understand what investing actually is. It is not a promise that the line goes up every week. It is a long relationship with uncertainty, discipline, patience, and prices that sometimes make you feel foolish. Maybe your first crash is not the end of your investing life. Maybe it is the beginning of the serious part, where you stop asking how to avoid every red day and start building a financial life that can survive them. The market can recover before your confidence does. That is why the goal is not to become fearless. The goal is to become harder to knock off your own plan. If your first crash teaches you that, the loss may become tuition instead of a permanent scar.